What's going on, guys? My name is Michael. Welcome back to Imperative Finance, and in this video, I'm going to quite literally change your financial life forever. I am going to share with you one of the biggest ways the rich not only become rich, but also stay rich. They do this by the fourth type of income, which some of you may know about, some of you may not. It's called phantom income. Now, before we get into it, I want to give a huge shout out to Robert Kiyosaki and his book, Why the Rich Are Getting Richer. In that book, Robert does a great job explaining this topic in simplistic detail, and I absolutely just had a blast reading it. A phenomenal book all around. Again, I'll leave a link down below if you'd like to read it yourself. But with that said, I'm going to present and explain phantom income here today in this video. All right, so in order to understand the fourth type of income, phantom income, I first need to ensure that each and every one of you watching this video understands fundamentally the three standard types of income. I'm not going to go into too much detail here, but I do need to establish a baseline for us all to reference in this video. All right, so the first type is ordinary income. This is income that you quite literally work for. You all should be familiar with this story, all right? You go to your job, you trade your time for money, you get paid hourly or salary, and the government takes taxes out of your gross income before it even hits your bank account. So the important concept to remember here is that ordinary income is income that you actually work for, and it is taxed at the highest amount relative to the other two standard income types. The more you increase your ordinary income, the more your tax bracket increases, and the more taxes you will owe on your ordinary income. The second type of income is portfolio income. Portfolio income is what investors refer to as a capital gain. A capital gain is your profit on an investment due to the investment appreciating in price during the duration of your ownership. So if you own a piece of real estate that is worth $100,000 when you purchased it, and it is now worth $150,000, you have $50,000 in capital gains. The same can be said for a stock. You buy in at a certain price, it goes up in value over the duration of your investment, and the difference is your capital gain. Now, what's important to remember about portfolio income is that it is taxed at 0, 15, and 20% on most assets in the United States. Granted, that you held the investment for over a year. Therefore, it's a long-term capital gain. Whether it's 0, 15, or 20% depends on your income level. Point is, portfolio income is often taxed less than ordinary income, especially if you're in a very high tax bracket. All right. And B, capital gains are only taxed when you realize the gain, meaning you only owe taxes on portfolio income or capital gains when you sell an investment at a profit. So if my property appreciated $50,000 since I bought it, I have $50,000 of unrealized gain because I have not yet sold that property. The moment I sell that property, that unrealized gain turns into a realized gain, therefore triggering a taxable event whereby I owe taxes on that gain. Portfolio income. Now, the third category of standard income is passive income, or as a lot of people like to refer to it as cash flow. This is income that you literally do not work for. You don't trade your time for money. You literally sit back and the money comes in. It is income produced from an asset which you own, such as a rental property. Every month, those tenants will pay you passive income. Now, the important thing to remember about passive income is that although it is generally taxed at the same level as your ordinary income tax bracket calls for, its effective tax rate can actually become the lowest of the three standard income types, sometimes as low as 0%, by utilizing just one component of the fourth income type, phantom income. This is the income type that the rich know so much about that you know nothing about. You see, phantom income is not ordinary income. It's not portfolio income, and it's certainly not passive income. It is income completely unknown to the poor and middle class who just work for money. It requires financial education to understand what phantom income is. So what is it? Phantom income is effectively income which you keep in your pocket by utilizing debt and tax incentives to your advantage. What does that mean? Let's go over a few examples on how to generate phantom income. So first, phantom income from debt. Let's paint the picture here. You're working a normal 9-to-5 job. You work a year and you save up $25,000 of net after-tax dollars from your ordinary income that you produced, right? So let's just say that the taxes you paid on that $25,000 was $10,000. So the actual value of that $25K is $35K. That's what the gross was. Then you paid your taxes, $10K deduction, and you're left with $25,000. You plan to use that $25,000 to pay for a down payment on a house. What is the problem with that? It means that the effective cost, the effective value of that down payment really cost you $35,000. Well, what if I told you that if you use debt is tax-free. If you use debt to pay for that down payment, that would mean that your effective cost, your real cost of that down payment really is $25,000. You never had to pay any taxes to get that money. So this difference, this savings in tax is called phantom income. You have effectively saved $10,000 in phantom income by just using debt. instead of your own ordinary income. Now, you might be saying the debt on the down payment comes with an interest rate. Okay, let's say that interest rate is 6%. That beats a 30% tax bracket any day. And if you're a smart investor who's done their due diligence and acquire a property that actually cash flows, then what you will find is that the leftover passive income from that property can pay for that down payment interest expense. Effectively, the tenant is paying the interest expense. So this is where it starts to get very, very interesting. Not only have I created $10,000 in phantom income, but I've also saved a tremendous amount of time. I don't have to spend the entire year to come up with that down payment from my ordinary income. Now, the concept of your tenant paying down your loan, also referred to as amortizing the loan, paying it off, is also a form of phantom income in the sense that it is lowering the effective cost of what it would cost you to pay off that debt. Again, if I were to pay off that debt with my ordinary income, that's after tax dollars, meaning it would actually cost me more to do it that way than to have somebody else pay off my debt for me. So my tenant pays down the debt and it effectively costs me less because I'm not having to use my after-tax dollars. Another example is phantom income from depreciation. This is quite literally the strongest example of phantom income because you get this write-off no matter what. It does not matter how the deal was funded or if the value of the actual property is going up or down, you will get this write-off no matter what. That is absolutely incredible, okay? What you're telling me is that I can use somebody else's money. I don't have to use any of my own money. The actual value of the property itself can be going up, and I will still get a tax deduction from depreciation. You see, depreciation is a write-off that the government provides investors in order to accommodate for the physical wear and tear a property undergoes throughout its useful life. As it stands right now, each year, the government will allow you to write off whatever the property value is divided by 27.5 years. So let's say I have a $350,000 property. I can write off about $13,000 each year in depreciation expense. Now, remember earlier in the video when I said that taxes on passive income could be significantly or completely reduced in some cases by one component of phantom income? This is it. You see, let's say I have a $350,000 property and it produces $3,000 per month or $36,000 per year. Now let's say operating expenses are $20,000. This means that my taxable passive income at this point is $16,000. Now remember, passive income is taxed at the exact same rate as your ordinary income. So let's just say, for this example, for simplicity's sake, that my tax rate is 25%. Apply that to my $16,000 of taxable passive income at this point, and that means that I would owe $4,000 on this income. However, as I mentioned before, the depreciation expense on a $350,000 property would be about $13,000 per year. Subtract that from your $16,000 of passive income, and you're left with $3,000 of actually taxable passive income. That's only about $750 if you apply your 25% tax rate. So now you can begin to see how this looks absolutely ludicrous on paper. If you take the amount of actual taxes I paid, $750, divided by the actual amount of passive income that I took home, 16 grand, my effective tax rate on this passive income becomes 4.7%. That is insane. So with that said, the money that I saved in taxes, aka $3,250, is in fact phantom income. Now, if that blew your mind, just wait until I tell you about this. All right, so as I mentioned, even if your property value goes up, you still get that phantom income via the depreciation deduction. But if in fact your value does go up, you have hit the literal gold mine of phantom income. Why? Well, one, the actual value of the appreciation itself is in fact phantom income. But two, you can use that appreciation, phantom income, from your own asset to produce more phantom income for yourself. This is how the rich are able to acquire so many properties without waiting to save up enough money via ordinary income for a down payment. So what do I mean? Let's say you have a property worth $150,000 and it appreciates to $200,000. That means that you have an unrealized gain of $50,000. As you mentioned before, if you sell the property, that unrealized $50,000 gain will turn into portfolio income, thereby requiring you to pay taxes on it. However, if you borrow against the property, meaning you pull out a home equity loan in order to pull out that $50,000 of equity, then it becomes phantom income, completely tax-free, because you turned it into debt. Now, if you have a tenant in the property, then the tenant is paying the interest expense on that $50K home equity loan. So that means that that $50K tax-free phantom income is literally tax-free phantom income that you can do whatever you want with. However, if you're a smart investor, you will want to A, mitigate your risk, but B, you will want to capitalize on how much phantom income you can create from this phantom income. So what the rich will do is they will use that 50K tax-free phantom income as a down payment on another property. Why does this create more phantom income? Because it allows the investor access to yet another property that is capable of receiving phantom income in the 4 ways we just discussed. The investor lowers the effective cost of the down payment by using tax-free dollars. The investor lowers the effective cost of amortizing the loan by utilizing a tenant to pay off that debt. The investor reduces his taxable income via a depreciation deduction, and the investor creates phantom income through the appreciation of the property itself. That, my friends, is the cycle which the rich know so much about that so many people go through life never understanding. It can help people not only become rich, but stay rich. You see, once they acquire 10, 15, 20 rental properties, all cash flowing $200 a month, they don't have to work anymore. They no longer have a job which forces them to pay the highest amount of taxes out of all types of income. And the best part is they don't have to work at all for that cash flow each and every month. So you see, the key to the real estate game is understanding phantom income. Where does it come from? What does it do? And how do I keep money moving so that I create as much of it as physically possible? If you can just learn phantom income, you can make a ton of money utilizing debt and tax advantages. With that said, thank you so much for watching. If you enjoyed today's video, leave a like down below, subscribe for the journey, and I will see you in the next one. Peace.